And welcome to the channel. In today's video, we're going to talk about how to value a company like Terry Smith or Fundsmith. Now, Terry Smith is a famous investor from the UK, which is sometimes referred to as the British Warren Buffett. Terry has outperformed the market since the inception of his fund in 2010, with the CAGR being about 15% per year. Now, full disclosure on my part, I am a little biased towards Terry since I am an investor in his fund, Fundsmith, and have been for a couple of years. Terry is probably the investor behind Warren Buffett and Charlie Munger, which I have learned the most from by reading his fantastic book, Investing for Growth, and watching all the YouTube videos of his annual meetings. I want to show you a short clip of Terry himself explaining how to do the evaluation. It's pretty simple, and then we're gonna go over some examples from companies that I have in my personal portfolio, and then also check out some companies that I have on my watch list. And we will then end the video by doing a calculation of the free cash flow yield using Terry's method and taking the data from the financial statement of a company that I have in my portfolio, which is Meta. But before we get into it, I do want to ask you to smash the like button and subscribe to the channel if you haven't already. That is to say, if you get any value out of these videos. I also want to ask you to comment below if you have any good suggestions on companies for me to do an analysis video on. I'm always looking for great ideas on companies to research, and who knows, maybe I'll pick up my next investment from the comment section.
One of the key measures we look at is the free cash flow yield of these companies, which sounds a little technical for the non-investment professional, but isn't really. It's the amount of cash that the companies generate after all their expenditures each year, divided by their market value. Because we take the view that we own those cash flows. They may not pay them all back to us as dividends. They may reinvest some of them in the business to grow the business. Most businesses I've ever encountered need additional capital to grow, and we want our companies to grow. Or they may use it to buy companies. We hope that's not their most frequent use of cash, because typically that goes wrong, but there is some of that as well. But that free cash flow yield, whether it's used to acquire things, whether it's used to invest further in the company, or whether we receive it back in dividends, that's ours. That's what we own. And when I'm investing your money, I compare that free cash flow yield with a number of things. But my sort of bottom line yardstick on it is, and I choose my words carefully, is I look at the free cash flow yield on our companies and I compare it with what I think the long bond yield should be in any currency. And the key words in that sentence are should be, not what it is, because if you look at the long bond yield, you'll find it's, depending on which developed market you choose, somewhere between 2 and 3%. But it's of course at that level because across the developed world, governments have spent their time for the last couple of years buying their own bonds by so-called quantitative easing or printing money. And funnily enough, when they buy their own bonds, they don't pay a very high price in terms of coupon, because clearly one of the things they want to do is to drive down their cost of borrowing by this activity, one of the things that they want to do with it. And so they're basically arguing with themselves about what the yield should be on those bonds. And as a great man once said, an argument that a man has with himself rarely descends into a barroom brawl. And so when the government's thinking of buying its own bonds, it doesn't sort of say, well, I think the right price for these bonds is a 6% yield, which is, it pays this very low rate. So what should it be? I work on the following basis. I work on the basis that if I were a rational outside investor buying these bonds, and by the way, just as a footnote, governments will eventually have to get back to selling their bonds to those people because they are running deficits, they're spending more than their income. What should that yield be? If I were a rational outside investor, my guess is I'd want a yield of at least 1% over the expected rate of inflation. I want the protection of a 1% real yield from my bonds. And at the moment, depending upon what inflation figure you want to believe, but if you take the official ones, that would probably get you to about a 4 to 4.5% required yield on the bonds, I would say. So that's my kind of bottom line. I will only buy companies, therefore, that have a free cash flow yield, as I defined it for our companies, which is about 5% or more. And the reason for that is if I buy those companies with that yield that's higher than those bonds, I can be sure of one thing. Over the long term, the free cash flow yield of our companies will rise. They will generate more free cash flow as time goes on from that starting price that I own them at. I can be equally sure that the coupon on the bonds won't go up. That's what happens with bonds. They have a fixed coupon. And so we have almost certainly created real fundamental value if we can buy our companies on a free cash flow yield that is higher than bonds should be yielding at this time. Okay, I had a look this morning, and 23 of the companies that we either own or would be willing to own have a yield of more than 5%. It's not as many as I would like. I wish the whole lot had a yield of more than 5%, frankly. Then we could buy absolutely everything that we would like to buy amongst those companies. But we try and maintain the discipline of not overpaying.
Inflation in the US today is 3.7%, which means we could use the same number that Terry mentioned in his video. I like to use the inflation number in the US since that is the primary market that I invest in. Personally, I don't have any investments in the Icelandic stock market. But if I were investing in the Icelandic stock market and in the Icelandic economy, I would have to use the inflation rate of 7.9%, which means that my minimum free cash flow yield would be 9%. You can definitely pick up some companies in the Icelandic market that have a free cash flow yield of 9% or even more, but those companies are really low quality. If you look at my personal portfolio, where I have 9 companies and I have them sorted here by the free cash flow yield, going from the highest to the lowest. First off, we can see that Gravity is trading at an insanely high free cash flow yield of 16, Alibaba 13, Karkuru 11, and Tencent at 6, Evolution at 5, and Fortinet at 5. There are only 3 companies in my portfolio that are below the hurdle rate of 5% free cash flow yield, which is a good sign and means that my portfolio is undervalued, which is a good sign for the future and means that if I've done my work correctly, the portfolio will move from being undervalued to fairly valued and maybe overvalued, but we will have to see. I'm at least very happy at the moment with my current holdings. If we take a look at my watch list, which is a mix of companies that I've researched thoroughly and some other companies that I just put on there to research later. The companies are sorted from the highest free cash flow to the lowest free cash flow. And the first company on there is Inventronics, which is a Canadian microcap at a 20% free cash flow yield. You then have NVR, which Buffett bought into recently, the home builder, which is a much bigger company, but has a free cash flow yield of 9. Going down the list, you have a company called Bouvet, which is a consulting company from Norway, a small cap at $500 million market cap and a free cash flow yield of 7. You have an Australian company called Jumbo, which is a small cap trading at a free cash flow yield of 5. And those 4 companies are the only 4 companies that make the cut. Now, a company that I've done much research on and I'm going to release a video soon about is a company called OTC Markets, which is a $600 million small cap, which is trading at a free cash flow yield of 4.16. So the only problem there is the price for me at the moment. To wrap up this video, I want to show you real quickly how to calculate the free cash flow yield. I do think it will help you to understand the concept better if you've never seen it before. It sounds a little bit complicated, but once you see how it's calculated, I don't think you'll have trouble understanding it. And I think it's like doing math. You start off by doing it by hand. Then later, to save time, you move on to using the calculator. In this example, we're going to use a company which is a part of my personal portfolio and is in fact my biggest holding, called Meta Platforms. And you go to quickfs.net and you type in Meta. You go to the cash flow statement, and here you can see the trailing 12-month numbers for Meta. You have cash from operations for the last 12 months at 66 billion, and property, plant and equipment, or capital expenditures, are 28 billion. And if you deduct that from the 66 billion, you get about 37 billion of free cash flow for Meta. And then we go back to the overview and we find out what the market cap of Meta is, which it says right here, market cap of 798 billion. We then divide the free cash flow of 37 billion by the market cap, 798 billion, and we get 0.046 times 100 to get the percentage. And we find out the free cash flow yield for Meta is 4.6%, which is not that bad. Now, I won't be making this video any longer. I want to thank you for watching and hope to catch you on the next one.